Moneyweb Now, on the money. Also available on podcast.
I'm chatting with Riaan Campbell. He's an advisory partner at Citadel. A great quote from him: turn from being accumulators to consumers. He was talking around sort of investing, and particularly at that part of the life. We spend our life, we're buying, we're collecting assets, we're building wealth. But at some point, we're near retirement, and now we need to turn into that consumer as opposed to accumulator. Riaan, appreciate your time. In other words, we need to, after a lifetime of buying, we actually need to start looking at our assets and selling some of them. And I mean, that's hard for many reasons.
Yes, thanks, Simon. You spend as you say, you spend a lifetime accumulating assets and then designing a strategy for income. And at some point, your income might just fall short of your requirements. Mm-hmm. And then you got to take a hard look at your overall portfolio to find assets that you can sell at a very good level. Because most of the talk in the investment world is in what can you invest in.
Yeah.
And we're focusing for this purpose. We're focusing on what can you invest out of. To generate some cash and liquidity in a portfolio. And
some of that from a pure stock perspective is easy. You look at a share price that perhaps has gone absolutely crazy. Tesla springs to mind, but it's a bad example. But, something that's gone crazy, perhaps a stock that you've held maybe for decades, and it's now sort of overweight in your portfolio. You've probably got an attachment to it. It's made you money. You quite like it. But that's perhaps an easy one to trim some of the position, to truthfully reduce some risk and free up some cash.
Of course. I think the two things you got to look at there is overvaluation and overexposure. Now, firstly, when you get an asset class or a market or a specific investment that's become overvalued and it actually screams to be sold, that's number one you're looking for. Secondly, mostly in portfolios, you'll find something that's done, as you say, done very well for a person over the long term and giving you that has given you a very, very good return and has created the wealth for you. Mm-hmm. And that's the time where you look at that overexposed position. Like if you take an example in South Africa, a lot of people could be overexposed to Naspers now after the good run. And those are the two things, obviously, to look for when you look for assets to sell, to raise liquidity.
The one which I've always found quite easy in my personal portfolio, because I struggle. Selling losers, I have no problem with. It's my winners I find hard. But the other one I did find easy is sometimes you got that little straggler share. It's almost insignificant in your portfolio and it's not going to make any difference. But if you convert it into cash, that might actually help your cash flow. And those are certainly an option, and I think perhaps an easier option.
Of course. A share or a position that's become too small in your portfolio doesn't make a difference in the future. And then, of course, sometimes those small positions also have created tax losses, capital gains losses, capital gains tax losses, which you can actually utilize when you need to offset against other gains you've made elsewhere in your portfolio. So I think definitely if you sit around with too many small positions, it actually doesn't make sense.
Yeah, and as I said, I've had them before. Either I didn't have the courage of my conviction, or perhaps, as you say, it was actually a loss situation. And you mentioned tax, and of course, tax needs to be a consideration here. If we're selling our winners, there's going to be a tax liability, but we can't do this in a vacuum. We need to chat to our tax professional and make sure that we're doing it as effectively as possible.
Yeah, sure. One of the strategies you can follow is to sell over a few tax years. If you've got a very high capital gain, unrealized capital gain, you can always spread it over, let's say, 3 years. One in the last part of the first year, then in the second year, and then the first part of the third year, and you actually don't waste too much time. You could actually do it in less than 1.5 years.
Yeah,
3 tax years.
3 tax years. So sort of February, year, and then March. It's 14, 15 months, and you're actually into 3 tax years. We've been talking equity here, but of course, wealth accumulation over a lifetime is much more than just that. It'll be perhaps some lifestyle assets. It might be collectibles, coins, whatever the case may be. We need to look broadly across all of this. And I'm imagining when it's lifestyle assets, collectibles, probably makes it even harder because they're less about rands and cents. They're much more an emotional attachment.
Of course, when you look when you take a hard look at your portfolio or at your overall wealth position, you've got to look at those assets that are not really traded on financial markets, like your holiday home or a collector's car or whatever. And those things are normally bought for emotional reasons or for lifestyle assets. And then you got to detach yourself from those. And when you take a hard look, it's normally you got to take an objective view and say that this thing doesn't fit into my portfolio. I don't use it anymore. It doesn't generate income, and that's one of the keys. If an asset costs you money and it doesn't generate income, that's the time you should definitely consider selling.
That's a great point. My Naspers, even if I'm overweight, it's going to make me some dividend payments. My lovely, Roadster is not. It's costing me money. I'm going to go back to the, turn being an accumulator into being a consumer. A great quote, Riaan Campbell, advisory partner at Citadel. Really appreciate your time.